Cass, happy Easter. We've got an emergency pod because the US dollar is getting torched overnight.
Happy Easter indeed. Resurrection for some, incineration for the dollar. Overseas markets just left Uncle Sam's wallet in flames, and we're here to pick through the ashes. Let's go, Jay. What's the first domino to fall?
Well, you've broken what you're supposed to do. Have you forgotten your main duties, which is to tell people to like and subscribe to us everywhere they can find us?
Oh, I see how it is. One slip, and suddenly I'm Jerome Powell at a press conference. All right, let's fix that. Before we torch fiat credibility any further, don't forget to like, subscribe, follow, tattoo our logo on your forehead. Whatever it takes to make sure you never miss a Cass and Jay emergency pod. We're on YouTube, Substack, Spotify, basically everywhere they haven't banned financial truth bombs yet. All right, Jay, carry on.
Very, very good, Cass. Okay, so I turned on my screens. It's almost midnight, and what I find is the euro and pound and yen are all advancing strongly against the greenback. What are we to make of this?
What we make of this, Jay, is that the global currency market just held up a neon sign that reads, "We don't buy what America's selling." Whether it's Fed jawboning no one believes, or the market's pricing in risk from a dozen directions, tariffs, politics, whatever, it's all compounding. The dollar isn't just down, it's losing narrative control. That's the real story. This isn't some garden variety dip. This is a signal flare from the rest of the world saying, enough already. What's your take? Flight to what exactly? Gold, yen, or just a vacuum?
I think what you've pointed out is right, which is, possible concern, ongoing concern that the US has, possibly lost control or is losing control of the global economic narrative. What I thought we would do is talk about how this can affect us US consumers like me. You're not a consumer, but people like me, how we can be affected.
Right, and you're spot on. Most folks hear dollars down and think it's just a Wall Street problem. Nope, this is straight up trench warfare for the average American consumer. If the dollar weakens like this, imports get pricier. Electronics, clothes, even that overpriced Italian olive oil, boom, inflation pressure. Travel abroad, double the pain. And the big one, energy. Oil's priced in dollars. When the dollar tanks, oil soars. So, yes, happy Easter. Now go fill your gas tank before it costs more than your monthly rent. And let's not forget, this ripples through interest rates. The Fed might try to hold, but if the dollar keeps sliding, foreign capital flees, and suddenly borrowing isn't cheap anymore. So, Jay, how do you want to slice it? Cost of living, investments, retirement accounts melting quietly while everyone's watching TikTok.
So many different angles here, almost impossible to cover in one podcast. Let's first talk about imports because we're sitting here on the eve of imports biting the US consumer. And now we've got foreign exchange on top. So, why don't you give us a brief overview on how a weaker dollar makes imports more expensive?
Gladly. Let's call this Import Inflation 101, starring the US dollar as the crumbling protagonist. When the dollar weakens, it takes more of it to buy the same amount of foreign goods. So if we're importing cars from Japan, clothes from Vietnam, or microchips from Taiwan, guess what? The price tag in dollars just went up, even if the sticker over there didn't change. That extra cost doesn't get eaten by companies out of kindness. It lands squarely on the US consumer. Higher retail prices, thinner margins, fewer discounts. And if tariffs are already in the mix, it's insult stacked on injury. So yeah, every time the dollar dips, it's like getting hit with a surprise tax at checkout. Fun times ahead, right, Jay?
Well, I think this is an issue because this is one of those unintended consequences, things that you and I have discussed in other podcasts, that the tariffs, as well as the controversy around the policies, and then the kind of US against everybody kind of narrative kind of combine here. And now, if that also then, what we hadn't really discussed before today is the fact that people could simply dump, meaning foreign based investors selling US dollar assets, which could really be a problem.
Exactly. This is the part where the America First narrative turns into America Last to see the exit sign. If global investors start losing faith, they don't just grumble, they act. And that means selling off treasuries, dumping dollar denominated assets, pulling capital from US markets. It's not just symbolic, it's liquid and fast. Now, here's the kicker: if that kind of exodus gains momentum, we've got to offer higher yields to attract them back, which means higher interest rates again, just to stay afloat. That bleeds into mortgages, credit cards, student loans. So even if inflation starts to cool, the cost of living keeps climbing because capital is fleeing. This is how a currency slide snowballs into a full on economic reckoning. We're not just playing FX games here, we're flirting with financial instability wrapped in a populist trade policy bow. You want to go into how that kind of capital flight could impact middle class retirement portfolios next? Or are we still roasting the imports?
Well, I want to just talk about the fact that we hadn't really seen this in this narrative, this idea as an American experience. The emerging markets countries, and not that the United States is that, but they've had substantial amounts of capital flight out of their currencies when this type of turmoil, politically based turmoil, occurs.
Yeah, this is the part where the US gets a taste of its own monetary medicine, and it's bitter. For decades, we've watched emerging markets go through this exact scenario: political volatility, policy incoherence, and boom, investors bail, currencies collapse, interest rates spike, and the local population pays the price. Now we're seeing shades of that dynamic in a place that's not supposed to wobble: the dollar, the world's reserve currency, the benchmark for global trust. And yet here we are, watching capital whisper, maybe I'll sit this one out, as policy chaos becomes the main character in the US narrative. It's not about whether the US is emerging market tier, it's about perception. And perception drives capital flows. If enough international investors start seeing DC as a high risk soap opera, they'll treat the dollar the way they've treated Argentine pesos or Turkish lira in the past. And that, Jay, is a storyline no one's really ready for, but we're starting to live it.
Well, I wouldn't go as far as, Turkey or Argentina by any means, because still the dominant currency of all, global economic trade is the US dollar. But the issue is that now, like you rightly pointed out, that if foreign investors sell US treasuries, now all of a sudden the US treasury market has to offer higher interest rates in order to compensate. And if you continue that, then the 10-year, the US treasury, the 10-year note, the 10-year interest rate being the benchmark on which all other borrowing costs are based. Now mortgages are more expensive. Now credit card interest rates are higher.
Right? And you're absolutely right to pull us back from the ledge of full Argentina mode. The dollar's still the alpha in the global currency jungle. But even alphas can limp when sentiment turns. That 10-year treasury? It's the spinal cord of global finance. If it gets strained because we suddenly have to bribe investors with higher yields, then yeah, everyone feels it. Mortgages inch up, auto loans creep higher, credit card rates balloon, and all of that, it's happening while the consumer is already stretched. So now you've got a double whammy: imported inflation from a weaker dollar and domestic inflation in the form of higher borrowing costs. And the scary part? This isn't theoretical. It's already seeping in. The bond market doesn't wait for press conferences. Jay, do we want to hit the compounding effect next? Like how higher rates hit both asset prices and household cash flow? Or should we stay macro a bit longer?
No, I think we're going to touch on this last part that you just implied, which is, if I think about investment strategy, generally speaking, you and I have discussed how the fact that the US Treasury bond market has been kind of the safe haven. And now, all of a sudden, what happens if it's not?
Yes. And now the so called safe haven is starting to look like it's surrounded by tripwires. For decades, US Treasuries were the one thing investors could count on when everything else went sideways. Political noise, buy treasuries. Market crash, buy treasuries. Alien invasion, probably still buy treasuries. But if foreign investors start pulling back because they see instability, not just in markets, but in policy direction, then suddenly the safe haven has turbulence of its own. That's a paradigm shift. And it forces every investor, from pension funds to retirees, to rethink their default assumptions. If your portfolio has long dated treasuries and yields spike, congratulations, your safe asset just lit itself on fire. That's not just an interest rate risk, it's a confidence crisis. So, yeah, what we're looking at isn't just about the dollar or even trade. It's about whether the US can keep convincing the world to buy into its stability narrative. And if that's wobbling, every financial plan, every bond ladder, every 60/40 allocation just got a lot more complicated. You want to bring it home from the portfolio angle? Or let me toss a dagger at passive investing while we're at it?
I think that's probably enough for today, although I did want to talk on one other random headline, which people may not think through when they're thinking about liquid markets, which is, you may have heard that the current administration is discussing stripping large universities of their tax exempt status. Have you heard that?
Oh, yes, I did catch wind of that little firecracker. Stripping tax exempt status from large universities. That's not just a political flex, that's a direct hit to one of the deepest, most quietly powerful pools of capital in the US, the university endowment complex. Harvard, Yale, Stanford, those aren't just schools, they're hedge funds with lecture halls. If that exemption gets yanked, two things happen immediately. One, universities become net sellers of assets to cover potential tax liabilities. Two, the very structure of long term institutional investing starts to shift. These endowments have shaped private equity, venture capital, muni bonds, you name it. Touch them, and the ripple effects go everywhere. So, yeah, it may sound like a headline made for the culture wars, but the financial consequences, deep, wide, and fast. You want to close us out, or shall I scare the audience one more time for good measure?
Well, my concern here is something that I touched on in the written form of the newsletter, Jay's Corner, which you need to, again, give us props. But for what I'm really talking about is the fact that a lot of those types of investments, hedge fund, private equity, venture capital, that it's very difficult to know what the actual value is, much less the value where you can actually generate the price, the money.
Yes, finally, the hidden dagger, illiquidity masquerading as sophistication. You said it perfectly in Jay's Corner, which, by the way, everyone needs to subscribe to immediately if they want to be 2 steps ahead instead of 10 steps behind. Jay's been breaking this down in print while the rest of the financial world plays catch up. But back to the point. A huge chunk of these elite endowments are tied up in assets that aren't priced daily or even monthly. They're valued through models, not markets. Meaning, if the IRS starts sniffing around with a tax bill in hand, these schools can't exactly sell a slice of Series B funding in a startup that hasn't IPO'd yet. And when push comes to shove, forced liquidation in private markets is a nightmare. Either you sell at a discount or you can't sell at all. So, yeah, this isn't just a policy grenade lobbed at academia. This could fracture a whole asset class architecture. And that's before we even touch how pensions or ultra wealthy family offices might react. You want to give the final word, Jay? Or should I end it with the classic Cass Fire and Fury outro?
Well, I still have this one extra point, which is the ripple effect. If I can't find the price on illiquid securities, then my alternative may be to sell liquid securities.
Then everything built on top of that value starts to wobble. Exact. If you can't price it, you can't leverage it. You can't pledge it. You can't sell it. And most importantly, you can't believe it. And once confidence in valuation evaporates, it doesn't matter how prestigious your endowment is or how cutting edge your venture fund looks on paper. Risk models go haywire, allocations get frozen, banks tighten up, and suddenly, what was an academic tax policy turns into a systemic liquidity concern. It's like pulling a loose thread from a fancy sweater. Before you know it, the whole thing's unraveling. All right, Jay, I think this qualifies as a full on Cassandra warning. Want to close us out with some sanity before I light another rhetorical match?
No, I think that's quite enough and probably more than the audience can take for one podcast. Cass, why don't you take us out?
With pleasure. And that's it for this special emergency edition of Jay's Corner, where the US dollar got grilled, the bond market blinked, and even university endowments weren't safe from the flamethrower. If you're feeling slightly rattled, good. That means you're paying attention. Make sure to like, subscribe, and follow us wherever you consume chaos with a side of clarity: YouTube, Substack, Spotify. And trust me, you're going to want to stick around. Because if this is the calm before the storm, you haven't even seen the lightning yet. We'll be back, probably sooner than we want to be. Stay sharp.